Are you ready for the biggest shock to hit the housing market in decades? Hold on tight because the future of home ownership in the U.S. is about to take a dramatic turn. A housing crash is coming, and it's going to change everything you thought you knew about real estate. In this video, you'll discover the warning signs and the factors driving this impending disaster. As we know, the well-known and used Case-Shiller Index is a widely used measure of home prices in the United States. It tracks changes in the prices of existing single-family homes across 20 metropolitan areas. The index is used by economists, real estate professionals, and policymakers to track the health of the housing market. Despite its widespread use, the Case-Shiller Index has been criticized for not accurately predicting the incoming housing market crash. This is because it's based on past home sales data and doesn't take into account the underlying economic and demographic factors driving the market. Some economists and experts are sensing history is going to repeat itself any time now. Some experienced economists suggest that the decline in home prices in the U.S. will accelerate further in 2023. He attributes this expected decline to two main factors: low affordability and growing inventory. This could have far-reaching implications for the U.S. housing market and the economy as a whole, as a decline in housing prices can contribute to a decline in consumer spending, a wave of foreclosures, and a decrease in credit availability. This could be even worse than what happened 15 years ago. We're talking about the housing crash the country saw not so long ago in 2008. But what led to this disastrous situation? Many factors. Let's have a look at them. Before that, please show your appreciation by clicking on that like button and subscribe to our channel for more informative content. Now, let's continue. At that time, many banks issued mortgages to borrowers with poor credit who were unable to repay their loans. These attractive loans were firstly featuring variable interest rates and, secondly, given on little documentation. As demand for housing increased, so did housing prices. This allowed people to buy houses who didn't have the income to afford, and as a result, many borrowers defaulted on their loans when their monthly payments were increased or when their housing prices declined. Now, when your income isn't sufficient to pay back the interest and loan, add on the questionable credit history, which might as well be non-existent, you will definitely face problems down the line with repayments. This is exactly what happened at the time. As more and more borrowers defaulted on their loans, banks and mortgage lenders began to suffer significant losses, which led to a decrease in the availability of credit and a tightening of lending standards. This, in turn, made it more difficult for people to obtain loans to purchase homes, further decreasing the demand for housing. And so when demand decreases, so did the value. With fewer people looking to buy homes, the supply of homes for sale increased, putting downward pressure on housing prices. So many homeowners found themselves in a situation where they were no longer able to afford their due mortgage payments. This caused a rise in the number of foreclosed homes, further increasing home prices. Banks and investors faced heavy losses, which gave rise to the financial crisis of 2008 and the burst of the housing bubble. This situation directly impacts the mortgage markets, home builders, home supply retail outlets, Wall Street hedge funds held by large institutional investors, and foreign banks, increasing the risk of a nationwide recession that we know did occur. And the U.S. wasn't alone here. According to The Guardian, the drop in house prices touched 16% in 2008 in the UK, which is massive. Just December of 2008 saw a 2.5% drop, which was the second biggest fall of the year. The month of May was even higher, 2.6%. Moving back to the U.S., according to the National Association of Realtors, NAR, sales were down 13%. Economists believe this could wipe out homeowners' equity, making them owe more than their house is worth. Well, fast forward. Where are we headed today? Truth be told, we see a similar downfall approaching very soon, and we aren't the only one who are sensing a housing crash. Ian Shepherdson, the founder and chief economist of Pantheon Macroeconomics, is suggesting that the decline in home prices in the U.S. will accelerate further in 2023. He says this expected decline is due to two main factors: low affordability and growing inventory. There has been a lot of learning, and the U.S. housing market and lending practices have undergone significant changes since the 2008 financial crisis. One of the major changes has been the tightening of lending standards, particularly subprime loans, which basically don't exist today. Bloomberg reports that investors are seeking to pull $20 billion from the core real estate funds as the property value declines. For almost a decade, big companies and investors with the big bucks purchased hundreds of thousands of single-family homes with the goal of holding onto them and later selling them for a profit. It's called the iBuyer program, where an iBuyer is a company that can make an offer on the house instantly using technology. Currently, the largest iBuyers in the U.S. are Opendoor, OfferPad, and Redfin Now. In this competitive market, iBuyers have been buying homes for more than their actual worth in order to secure market share and gain an edge over their competition. The goal is not to necessarily make a profit on the initial purchase, but to hold on to the property and sell it for an even higher price later on. So much so that in the fourth quarter of 2021, around 20% of all the houses sold in the country were to investors. This means these giants are in hold of a lot of the properties out there. The argument is that these investors have been inflating prices in the market, and without their presence, prices will come down and the market will crash. We can count so many factors as to why investors are pulling out of the housing market, like economic conditions, interest rates, supply and demand, and a range of other factors all could have impacted it. It's true that investment companies play an important role in the real estate market, and their financial health can really impact it. If multiple investment companies go bankrupt at the same time, it could lead to a decrease in demand for properties and a drop in home prices. However, it's also worth noting that the real estate market is influenced by many other factors, including economic conditions, interest rates, consumer confidence, and supply and demand dynamics. A sudden change in any of these factors could also contribute to a market crash, even if investment companies remain financially stable. According to KPMG, one of the big four accounting firms, U.S. home prices are to fall 20% between the last quarter of 2022 and the end of this year, 2023. But why? The main reason being increased mortgage rates. Yahoo Fortune tracked down 29 of America's leading housing researchers in search of answers to what's coming. And the result? Well, 5 of them believe you won't have to worry, all is fine, and the prices will only increase as the year 2023 progresses. But the rest of the 24 believe these prices have yet to fall even further, and we are in for yet another house pricing crash. You do the maths now. Redfin indicates the sale prices to fall 4% this year. According to Keller Williams Realty, it's going to be a 10% fall. According to Morgan Stanley, if the deep recession manifests itself, we can see a 20% house price crash from top to bottom. And Moody's Analytics predicts a similar 15 to 20% price drop. Real estate apps, such as online listing platforms, show home prices that are initially listed too high and then drop after a short while. This is a clear indication that the real worth of these houses is way lesser than the listed price. One reason is that homeowners and real estate agents may price their homes in the upper margin to test the market and see if they can get a higher price. However, if the initial listing price is too high and the home doesn't receive any offers or interest, they may need to reduce the price in order to make the home more attractive to potential buyers. This bursts the price bubble and is another indication that people aren't really going for the pricey houses. In the end, it all boils down to affordability. We all know how inflation is through the roof, and the after effects of the pandemic are still very much among us, affecting every aspect of life. Chief economist at Moody's Analytics says affordability has evaporated, and with it, housing demand. Which is true. Whatever the future may hold, we can only invest wisely and hope for the best. With that, we've come to the end of this video. Thank you so much for watching, and we'll see you next time.